There are these invisible rule books that basically run our entire economy. And I'm not talking about laws passed in Parliament. I'm talking about the accounting standards that decide how companies report their financial health. And right now, some of the biggest, most important chapters in that rulebook are getting a massive rewrite.
I mean, really think about it for a second. That free phone you get for signing a 2-year contract, how does the company even account for that? Or when a private company builds a huge public toll road, who gets to say, yep, that billion-dollar asset is on my books? Well, the answers to those questions are changing in a big way, and they tell us a whole lot about the real financial story of the companies we deal with every single day. So, here's our roadmap for this explainer. We're going to start with this hidden financial revolution and why the rules are changing in the first place. Then, we'll dive into the secrets hiding in your phone bill. After that, we'll look at the new 5-step rulebook that's making it all happen, scale things up to massive infrastructure projects, and finally, we'll explore the ripple effect and why all of this matters to, well, everyone.
Okay, so at the heart of this whole revolution are two major updates to the financial world's operating system, if you will. The first is MFSR 15, and it completely redefines how companies report the money they make from customers. The second is IC 12, which is a game changer for those massive infrastructure deals. And believe me, these aren't just tiny tweaks, they are fundamental shifts meant to make financial reports way more transparent and, maybe most importantly, consistent across the board.
The big idea here is actually pretty simple. Level the playing field. You see, before these changes, you could have a software company, a telco, and a construction firm all reporting their revenue in completely different ways. It made trying to compare them, apples to apples, almost impossible for investors. The new goal is to have one single, solid model that everyone has to follow.
So let's make this real. We'll start with something most of us have, a mobile phone contract. This is where the kind of abstract theory of MFRS 15 smacks right into a deal we see all the time.
We've all seen these offers, right? Get the latest and greatest smartphone for a massive discount if you just sign up for a 2-year plan. To us, that's a great deal. But to an accountant working under MFRS 15, it's a classic bundled sale, and it creates this really fascinating puzzle about when the company actually gets to say it earned its money. All right, check this out. Let's compare two customers. Customer A just walks in and buys the phone outright for $2,300. No contract, super simple. The company books $2,300 in revenue that day. But now look at customer B. They get the same phone for a discounted price of $1,800 because they signed a contract. Now you'd think the company books $1,800, right? Nope. Under the new rules, they actually have to book more revenue up front, $1,992 to be exact. Wild, huh? So here's the burning question. Where does that extra $192 come from? Well, the new rule basically says the telco has to look at the total value of the entire contract and then slice it up based on the phone's true standalone price. That $500 discount they gave customer B, it's not just a marketing expense anymore. It's part of a calculation that essentially pulls revenue from the future service into day one.
And this is the absolute key. MFRS 15 forces the company to unbundle that deal. The phone itself is one promise, or performance obligation, and the monthly service is another. All the money the customer is going to pay over the whole contract gets divided up between those two promises based on what they'd cost if you bought them separately. This changes not just how much revenue gets reported, but crucially, when it gets reported. So how do companies actually do all this? Well, this whole process is driven by a really powerful new 5-step model. It's the engine behind this entire change, and it applies to pretty much every contract with a customer.
And here's that framework in action. It's actually really logical when you break it down. Step 1, identify the contract. Easy enough. Step 2, figure out the separate promises. In our example, that's the phone and the monthly service. Step 3, calculate the total price. Step 4, allocate that price between the phone and the service. And finally, step 5, you only get to count the revenue when you've delivered on each promise. It's a clear, disciplined flow. Okay, let's zoom way out now. We're going from our phones to something much, much bigger. We're talking about those public-private partnerships that build our highways, our airports, our hospitals. The accounting rules here, which fall under IC 12, have also gone through a seismic shift.
These deals are called service concession arrangements. The basic idea is that a government hires a private company to design, build, finance, and run a huge piece of public infrastructure for a really long time, like 30 or 40 years. For ages, the big question was always, who actually owns the thing?
And here is the absolute game changer from IC 12. The operator, the company that built the road,
does not own it. Even though they poured all the concrete, they don't get to list it on their balance sheet as a physical asset. The new rule makes it crystal clear. The operator is just a service provider, doing a job for the government.
So if they don't own the road, what do they have? Well, it boils down to one of two things. Under what's called the financial asset model, the government guarantees it will pay the operator. It's like having a giant, super secure IOU from the government. But under the intangible asset model, the government gives the operator a license to charge us, the public. Think toll booths on a highway. In that case, the asset isn't the physical road, it's the valuable but intangible right to collect those tolls. And how you account for these two is completely different.
Okay, so a phone company changes how it books a sale, and a construction firm can't call a highway its own. Why should anyone who isn't an accountant care? Well, because these rule changes create these huge ripple effects that spread across the entire business world.
This quote from PwC really just nails the challenge. This is not a switch you can just flip overnight. Companies needed years, literally years, to get ready for these changes because the impact goes way beyond just the finance team.
And so much can go wrong. Imagine your entire IT and billing system just isn't built to do these new calculations. All your key metrics, like average revenue per user, are suddenly useless for comparing this year to last year. Executive bonuses that were tied to the old revenue numbers, they might need a complete redesign. Even bank loans that have performance requirements might need to be completely renegotiated. It's a massive, company-wide headache.
But despite all those challenges, it's really important to remember the end goal here. The whole point of all this pain is to strip away the weird accounting tricks and give investors and all of us a much clearer, more honest, and more comparable look at how a company is really doing. It really leaves you with a fascinating question to chew on, doesn't it? These new standards are what we consider the truth today. But as business and technology keep changing at lightning speed, you have to wonder, what parts of today's financial statements will people in the future look back on and think, wow, can you believe they used to do it like that?